Welcome. You just entered the trading pit. Your home for sophisticated analysis of the crypto markets. It's another gorgeous morning on February 20th. And here in the studio is JJ and Bill Nilly of J Labs. Gentlemen, welcome. As always, I am your host, Marconi White. Today's story, Ether's fundamental supply outlook is better than Bitcoin. According to Greg Magadini, Amber Data's director of derivatives, Ethereum's native token appears more favorable to Bitcoin. Magadini goes on to say, combined with ETH's supply burn with dormant staked ETH and a mix on spot ETF, actively putting ETH into cold storage, all of a sudden the supply story for ETH is as bullish as fundamentals can get. JJ, is Magadini overselling ETH's potential to run hot this cycle?
No, I don't think at all. And when we factor in things like the ETF flows and things we'll get into today in terms of DeFi usage and kind of the growing yield space in ETH, I think this is just going to continue. We're going to see more ETH burned and ultimately more demand come in. So that's kind of creating a perfect storm for ETH this year. As we've been alluding to over the course of the last few podcasts, it's the market's severely underappreciating how fast this could run in how quick of a manner. That said, we're a little overheated now, but we'll get into that later.
A little hot. A little hot.
Big picture, though, like it's one of the fattest pitch setups of all time, I think.
Oh, well, you know, JJ and his baseball analogies. Ben, Magadini doesn't really mention the impact on DeFi. And we were talking just before the show, we've been talking offline about the impact of Ethereum's growing DeFi ecosystem, the fact that it's 60% of total TVL that's locked, and it just continues to grow. And as people are looking for yield, it seems like that's going to be another sinkhole for the Ethereum supply. So what's your perspective on how impactful DeFi is to that supply shock?
Hey guys, and happy new week here. Happy to get started. And when it comes to Ethereum DeFi, we look at an ETF as like this scary vehicle where tokens kind of get locked up. They're no longer providing transaction fees to the network, and they kind of just sit there and grow old. But I think with the way that Ethereum's trending, this might actually not be the case here, because it's going to provide so many opportunities for yield within DeFi on that ETH, which is in part why you probably saw that amendment with BlackRock to go ahead and kind of have those staking components involved, because they see the writing on the wall. And the new trend of this liquid restaking tokens, thanks to EigenLayer and some of the protocols that help facilitate that liquid restaking, such as EtherFi is one of the three more popular ones. Excuse me. We see the next stage of staking and kind of its maturation happen on Ethereum, and it's providing this interesting view of yields that no other network has really had to date. And this whole new market is starting to grow, and it's very exciting. There's good liquidity, there's good yields, and it's on ETH, right? This isn't 2020 where you go ahead and exchange your ETH to go ahead and accept some other token. This is essentially ETH for ETH. So
it sounds like there is a tremendous sinkhole, if you will. I don't mean to sound negative, but I mean, they can really capture a lot of the Ethereum supply, use derivative tokens or other types of tokens so that you can still have liquidity on the system.
Absolutely. Everyone talks about supply shocks, which is really just tokens kind of being locked up, or the supply itself kind of going down, or they're having, influencing new emissions of Bitcoin. Here, this is tokens getting locked up to a higher degree. That creates conditions that are ripe for supply shocks. And this chart right here that I have, it's kind of Ethereum and its token supply. Back in a couple months ago, I went ahead and broke down kind of the way that we look at token supply in general, which is through M0, M1, M2, M3. These are definitions of kind of the supply. M0 is fully liquid sitting in a wallet. M1 is liquid tokens sitting in a smart contract. You can think of this like DEX swap contracts. So these are fully liquid. M2 is locked up. And so that would be kind of tokens that are natively staked to Beacon Chain. This would be tokens that are being lent out for borrowing purposes. And you can see that that's kind of that salmon color at the top, and it's becoming a pretty large chunk of supply. And as that grows and expands, that is a recipe for supply shock. And so as these tokens move into ETF, we'll probably categorize that as M2 because they really won't be liquid unless they go ahead and follow that amendment of staking. Then we would make those adjustments at that time. But as supply starts to shrink as well, again, that's just kind of a second catalyst to supply shock factors.
It sounds like an amazing setup coming, especially with ETF on the horizon. Obviously, never guaranteed, but with BlackRock being behind it and others, I think we're all sort of sitting pretty confident that this is going to go through this year. And when it does, boom, boom, fireworks. Let's see. All right, I do want to get in and talk a little bit more about buying up Ethereum. We'll have some questions about how to trade that. We've talked about it before on the show. I want to revisit it. I know, JJ, you just mentioned we're running a little hot, but why don't we go ahead and start to break down the market a little bit more? I look at a little pre-market trading. Looks like Bitcoin is looking good. It's definitely up above 50K. It looks like it would just touch maybe 53K. Ethereum looking like it's on the doorstep of 3,000. So, JJ, walk us through this. What are the spot markets looking like?
Yeah, so we had that retest of 50K over the weekend. It was kind of a low volume, typical weekend kind of predatory price action, wick down, and then it quickly recovered. This morning, we kind of had the inverse effect where it ran up hot in the liquid pre-market hours, and now we're kind of finding an equilibrium here around 52K. And it's all going to depend on what these ETF flows are, right? We're all just dependent on that. I think over the past month, it was something crazy like, 100K BTC inflowed into ETF. So it seems like that's going to be hard to sustain. It seems like that's what the market's really betting on for higher prices here, is basically continued buying, and we're going to have to wait to see what the flow show us. These New York sessions have been very telling. So if you just basically watch what BTC does throughout the course of 9:30 a.m. through 4 o'clock p.m. Eastern time, you have a pretty good read on the market in terms of what these ETF inflows are actually looking like. If we start to see BTC break down towards the lows, that's probably a good sign that we've reached kind of your peak for the moment, right? Like these ETF inflows that we experienced over the past few weeks are going to be very difficult to sustain, I think. So it's really dependent on that from here. It's hard to say one way or the other what it's going to look like this week until we actually know for sure.
Yeah, absolutely. Ben, I want to ask you a question about that because you have written substantially about the Bitcoin ETF kind of being telegraphed by what you saw with gold. Have you been surprised by the amount of interest in the ETFs as a starting point?
Yes and no. There was plenty of time to kind of ramp up how that was gonna take place when the sounding bell began, and I believe there was so much on the table per kind of the GLD ETF, just absorbing outsized AUM early on, and it's been paying dividends ever since. And understanding that happened in the 2000s, and here we have kind of Bitcoin, which is digital gold as the narrative goes, and it's essentially a second swing at that. There was a lot at stake here, and so I think a lot of these shops had a lot of kind of manpower ready to really do what they wanted to do. But that is a little bit of kind of looking back, right? Got a little 2020 eyesight now. I didn't fully expect it to be as strong as it was. I thought it was going to be strong, but this is like completely changing the flows. Like your opening bell kind of determines like the week right now. Like that's how impactful this is getting. So even at the end of last week, I made a post on X just saying like, hey, look, things are starting to taper down a little bit going into the weekend. Now we don't have the ETF flows really taking place on Saturday and Sunday. I'm not even 100% sure on that comment right there. You know, we might have just changed the operating hours of Wall Street here because of how much is on the table. But at the end of Friday, it looked like everything was tapering off, and that softness would continue into the weekend. But it was not much of a sweep to the downside. I was pretty surprised at how shallow it was. So interested to see how this kicks off here in the next 5 minutes.
Yeah, I thought it was going to run deeper over the weekend as well, like when we got that move down to 50K, but you saw that kind of support come in at the lows, and it kept it in technical range, like everything stayed intact. So it's going to be interesting to see what these flows do if we go back down and retest, or if it just keeps being this up-only, infinite demand.
And you got DXY. I don't want to jump the gun here, but DXY is starting to make its move to the downside.
Yep.
All right, well, let's definitely come back and revisit that. Pancake Lord, Vinny, Adam, welcome to the show. All those who are in the chat, obviously hit the like button, hit the subscribe button. Love to have you guys here. Share with anybody you think would enjoy a more nuanced and sophisticated analysis of the market. All right, so from a spot perspective, obviously stronger than we were expecting, perhaps. I think part of that is our mental model going into this has really been part of what we've experienced for the last couple of years. The ETFs, as you said, Ben, are maybe starting to change the market, which is an interesting paradigm. JJ, what about from a perpetuals perspective? Because I know over the weekend you started to look at it, if it was the options, it was perpetuals. You started to see some different behavior, made it look like we may start to see a slowdown in some of the interest there. So walk us through what you're seeing and whether or not that's indicating a move, perhaps even higher.
Yeah, so last week we were touching on the major options expiration that was coming, and we were pointing out how all those strikes were in the money, and they were going to have to hedge one way or the other. So what we basically saw after that was a lot of profit taking on perpetuals. So basically they were short out of the money calls, and then when those calls became in the money, they were hedged with perpetuals, so they closed those down. You can see this pretty clearly here on derivatives flows. So basically when price started breaking out above 44K or so, they got ultra long on these derivatives. Then after the options expiration, they closed those positions along with the calls that were in the money, and they basically went net flat there. And then we saw some repositioning in the options market after that expiration, and it looks like kind of they're just loading up on volatility in both directions. So I saw in the flows, it's going to be hard to see this in any one specific area, just kind of piecing it together. Looked like there was a lot of put buying and shorter dated options, so ones that are going to be expiring in March and towards the end of this month. We could see this here. So here's the options expiration coming up this Friday. Basically, since February 15th, we saw the put to call ratio drop, which signifies more puts entering the market. We basically went from 24,000 open puts on this strike or this expiration date last week to now there's over 30,000 puts open. So there's a 6,000 jump in put options there. Then we look at March, there's another large run up in put options here. And it seems like they're going further out for the calls. So if you go to, say, April after the halving, or I'm sorry, June, we see the call ratio rising. So it looks like they're getting long. So you want a long call exposure towards the second half of this year, and more in the shorter dated options, they're getting puts. So they're just kind of preparing for both scenarios here. Probably selling some at the money volatility on shorter dated stuff too to fund this a bit. And then they're buying puts that expire over the course of the next month or so and calls that expire further out. So that kind of seems to be the net positioning there in options. It's just preparing for more volatility. Like, I don't think the market has the expectation of us just staying in this 50K range very long. Either we're going to break out or break down, but the options market's prepared for it now.
And just to kind of add a little bit of color there, JJ, you've been talking about the term structure chart. So this is implied volatility across expiries on given dates. And on my current screen, I have the today's in the light blue, and you can see it's much higher. And kind of JJ's been talking about a lot of this activity with volatility incoming. So you can see that difference in just a week. This is the blue line a week ago. And so it's quite significant difference. And also the shape, I think you wrote about this recently, where the dark blue, this slope here early on, this was kind of alluding to opportunity to go ahead and go long volatility. And you can see it starting to flatten out a little bit.
Yep. If we look at the perps too, I know you asked about that. So it still seems like a lot of this cash and carry trade. If you look at the long short ratio, it's still extremely low. It's still right around 1, which isn't necessarily signifying overheating, but we see open interest rising. So this just signifies the ongoing basis trade of capturing the yield by shorting the perpetuals against spot. And then if price doesn't expand beyond a certain range, you just collect that funding and you're hedged if price goes down. So it seems like that's still continuing. Overall, this is kind of what you would want to see for continuation. The market's basically fully hedged. So that gives us a green light to go up if the market finds a catalyst here. Let's see what the flows do.
So am I right in saying that we're seeing the market buy some cheap insurance on the downside? If we do have a breakdown, they're prepared for that with those puts. And then they're also preparing for their position for volatility to go higher.
Yep.
Or for us to break higher on higher volatility.
That's it. They're basically betting on price not staying here very long. So you probably see some selling of like at the money volatility expiring within the next week or so. And then you take that premium that you collect and you're buying out of the money puts, out of the money calls, and just loading up for an expansive move one way or the other.
Okay. I think that gives us a good picture of what we're looking at in the crypto markets, particularly from a Bitcoin perspective. I know there's been a lot of activity on the altcoin markets. We were talking about that offline, about some of these smaller caps really seeing a lot of interest. And I want to talk a little bit about going down the risk curve. And then obviously we're going to have to get into the existential areas of the Dixie, talk a little bit about rates since we got Ben here. Before we do that, thank you for everyone who's here this morning. Please hit the like and subscribe button, hit the thumbs up button. It really helps us get out to as many people as possible. And if you are interested in starting to understand better what JJ's talking about when he talks about options and be able to follow some of those sophisticated trades, be sure to check out the link in our show notes so that you can start trading on CoinCall. CoinCall is one of the newer exchanges. It offers the best interface. I'm just going to say it out there right now. It's beautiful and elegant, very competitive fees, and you can look at options, perps, and spot for trading, all the majors. It's a great place to start your options trading journey. And as we talked about before on this show, it's important to get out there early and often so you're prepared for those fat swings. JJ was talking about a fat swing earlier on the show. You're not going to be able to take that pitch unless you're prepared, and a lot of that starts with practice. So go ahead and start experimenting on the CoinCall platform. Okay, JJ, I want to come back, and actually I can ask both of you guys. We saw over the weekend some run up on a couple of different sectors within the altcoin market, right? So traditionally what we talk about, Bitcoin runs, it kind of plateaus, Ethereum starts to get bid, it starts to plateau, and then you see the rest of the market. And I think some of the people were perhaps expecting more of that action to take place obviously further in the year after the halving. To see some of this now, I think when we're seeing things like WorldCoin start to run, you're seeing things like Ron. So you have a game narrative, you have an AI narrative. People are starting to ask, are we getting ahead of ourselves? So JJ, share your perspective there. Are people just really aping in at the wrong time? Or perhaps this is rational investment further down the risk curve, knowing what's happening with Ethereum?
I think it's just kind of a wealth effect that we see naturally in crypto. So Bitcoin's trending, it's been trending over 50,000 for over a week now. Ethereum's been trending over 2,500. So when that happens, you have this natural wealth effect where people who are long Bitcoin and Ethereum for much lower prices, now they have a significant amount of risk capital that they can go out and speculate further down the risk curve. And so long as Bitcoin and Ethereum hold above those key levels, odds are that your beta is going to outpace that, right? Like that's kind of the whole thing, is you want to find the next narrative, jump on it, and catch it before it runs up to 5x 10x, etc. So I think it's just kind of a natural progression that we see here. In terms of risk, like I think things are a bit elevated now, just in terms of like the likelihood of a correction from here. Like as we said, the options market isn't necessarily taking a specific view that price is going to go straight up. They're kind of prepared for both directions. So if you're all in alts, it's kind of a risky time, because if we do get that correction below 50K in the next week or so, if these ETF inflows slow down, those things are obviously going to get hit a lot worse. But in the meantime, like if things are running, just follow the trend there. I don't think it's necessarily like a sign of impending doom, right? It's just showing you how anxious this market is for more risk.
Right. Be long until you're wrong, right? Is
Exactly.
that what we're saying? Is that what we got tattooed a couple weeks ago?
Exactly that. Wrong until the ETF inflows slow down.
That's right. That's right. Ben, any perspective there? I mean, we've talked several times on different trades and sort of the sequencing. Is the flows from ETFs going to change some of that sequencing? Is it going to move people further down the risk curve earlier?
I think it will. I mean, we kind of saw a bit of a meme coin season already, and it's like almost itching to have a second one here, is kind of the sense I get from just scrolling through crypto Twitter. But as far as like understanding like how risky things can be right now, I kind of pulled up the Sortino and Sharpe ratio metrics here on my chart. And you really want a reading over like 1 when it comes to equities, and really crypto, you kind of want a little bit higher before you're willing to go out on the risk curve. These two ratios kind of help portfolio managers understand what kind of these risk adjusted returns look like. And so as these numbers get a little bit higher, then it's worth going down the risk curve, because you're going to go ahead and get the returns that are appropriate for how much risk that you're taking on. This has a little bit of flaw in that it is backwards looking, but it just gives you some perspective. So that's what this subplot here is. Don't worry about which one's which here. They're kind of reading the similar. One just takes a little bit more downside beta into its equation, but you really just want to see this kind of above 2 here. And this is Ethereum. And this is actually one of the better looking ones. And here's Cardano. That's going to be closer to 1. Solana's already negative. So it's just kind of showing you that the risk is a little outsized right now. Tron's actually looking pretty decent. And you got Polkadot here. That's right around 0. Avalanche is already negative. Atom is below 1. HBAR is an anomaly. It always is an anomaly in this market for some reason. Aptos is sitting below 0.
Yeah.
And I can keep going on, but I think you get the point here is that these risk-adjusted returns aren't looking as attractive as they were earlier on in looks like February. So right now, are you going to go ahead and take on that risk where we're at currently in the market? Just these ratios give you a good kind of reason to go ahead and tone it down and not necessarily go further out there.
All right.
One thing to keep
Well, there
an
you
eye
have
on this
it.
week too, like we talk about how all coins are downstream of what Bitcoin and Ethereum do, right? And ultimately, what Bitcoin and Ethereum are downstream of is legacy markets. And we know that they're obviously have been trading at all-time highs recently. That's mostly driven by NVIDIA. And NVIDIA has earnings coming out tomorrow evening, I believe. So keep an eye on that because look how obviously overstretched this chart looks on many time frames. This is an NVIDIA chart. So if these earnings disappoint the slightest, it'll probably see a large correction. And I highly doubt that Bitcoin and Ethereum are spared if this goes down in any significant way. So you just kind of have to be aware of the larger landscape that we're existing in here. And ultimately, all risk is downstream of what's deemed as less risky. So if less risky markets get risky overnight, then obviously risk markets will take a larger outsized hit there. So
yeah, it's a good point because that's tech stock. So a lot of funds will kind of classify Bitcoin as a tech stock as well. So if you start to have outflows in the tech sector, then Bitcoin and Ethereum are going to kind of get punished as well.
Yep. It's like what we discussed with Bitcoin and Ethereum. Like when people have gains there, they obviously parlay that into altcoins. What legacy people do is they get tech gains and they say, okay, I can go speculate on this more risky thing, which is Bitcoin or Ethereum, etc. So if that tide starts to recede, I think they'll get hit as well. It's just kind of a natural effect.
And a lot of times when that outflow does happen, you kind of get a sense of where the market's getting ready to go next. And you kind of see that in that beta response. So if you look at ETH PDC, I pulled the chart up here. Its risk-adjusted return ratings of the Sorrentino and Sharpe ratio are actually one of the most attractive ones I think I just pulled up on my chart this morning. But if you start to see this climb as we witness an outflow, that kind of is your signal that this next leg higher is going to really showcase Ethereum.
Mm-hmm. Yeah, it's ready for it. The market's geared up.
We have
more risk. We're just waiting for the inflows.
Well, I want to ask about that. And there's a couple of questions in the chat I want to be able to get to. One of them is about Bitcoin mining stocks. We've talked about playing as beta, so we'll definitely cover that. But the one that's I think we can answer right now, what's your assessment of the probability that Bitcoin will reach new all-time highs in the next 3 to 4 months, considering current market trends and options activity? This one comes from Adam S. Thanks, Adam. Guys, perspective there. Could you even put a probability on that we're able to get into 70K?
Do you want 70K this early in the cycle? I think that's my
too
question.
Much too soon. Yeah, I would say maybe 20% odds that we get there before June. I think it's just too much too quickly. Like you think about it, we've been up only since October. What are the odds of this continuing for another 20K? I think 60K, like a quick wick up there over the course of the next month, is more likely than all-time highs. But I think it would be hard to get above 70K by June.
Ben?
It's scary. If we do see it, we might see a daily close above it, but will we see a weekly close above an all-time high? No. And I wouldn't want to see it because the volatility is going to be very severe if that's the case. And I think if we were to look at it, we really got to assess ETF flows to realize if we do have enough kind of dry powder coming into the ecosystem. And it doesn't look like this cumulative flow is starting to wind down. This is Farside Investors' little table that they put together to go ahead and see how much Bitcoin is flowing between the various vehicles. And early on, you kind of see it's very small numbers, at least for February. You kind of got 100, 400, 500, and then you got a 600 that was coming in last week, and that really helped propel the market for the rest of the week. 400, and then we'll see what it is today. We'll kind of see what happens, and if you continue to see just higher values coming in, then the probability just keeps going up. But as far as putting an assigned number on it, a weekly close above the all-time high, I would say that's less than 10%. But give me a daily close, I could say that's 15 to 20% probability.
Looks like some selling going on here at the market open. Coinbase spot. Nice sell volume candle here. So just something to keep an eye on. Like, I mean, if this reverses and we're back above the highs that we traded at this morning, by the end of the day, it'll probably be full bull. But don't fight these flows. Like if the New York session takes us below 51,500, anywhere below there, I think it's probably starting to turn, and we're seeing those outflows slow. Just probably a good sign. The market needs a breather here. It's just been turning so hot for weeks that you should welcome these corrections if they come.
Well, it's been an interesting year. I think about the number of analysts that got last year wrong, sort of expecting some kind of a downturn, a reversion, and we really just didn't see it. And so I think there's a lot of unknowns here. I think the probabilities that you guys have put out are a good way to look at the market rather than think of it in binary terms. Really think about the probabilities that you can bet on. And then I think what's interesting, one thing you didn't mention, JJ, but it's in the background there, is that the ones who have the largest amount of money on the table are hedging in both ways, right? So they're not asking themselves, is it going to hit 70K? Is it going to hit 30K? They're basically saying, we don't know. We're going to buy some inexpensive insurance through puts, likely on CoinCall. And I'm also going to be looking to position myself if this goes higher.
Exactly that. Yeah. This is what smart money does. When price reaches these kind of critical inflection points, they're not going all in, they're not going all out, they're just buying insurance, and they're using premiums to pay for it in most cases. So you sell, say, a 50K call and you buy twice as many out of the money calls that expire later in the year. You buy some puts expiring in a month or so, and now no matter what price does, you're making money. It's kind of it's a beautiful opportunity that markets afford us if you know how to manage it.
Yeah, it's the sophisticated traders, which is what we're trying to get everyone to think like, so they can make the most amount of the biggest gains out of this bull market and all the markets to come afterwards. Okay, I want to shift our focus a little bit. We do have some other topics coming up, including Pancake Lord. We will come back to your question about the Bitcoin mining stocks. Before we do that, I want to talk a little bit about Dixie, and I want to talk about the rates. So JJ, I haven't pulled it up here, but Ben was mentioning it's starting to break down a little bit. Are we starting to see a crack in the Dixie?
Let's pull it up. So it looks like it's coming down to retest its 200-day moving average now. If I get these lines to load here. It's just, right now, it still looks like a healthy pullback in a larger uptrend. So I don't think this is necessarily like the ultimate risk-on signal we're looking for yet. I'd really want to see it like close below 103 to feel like it's kind of made like the uptrend is over, right? We see it's still above the 50 RSI here on the weekly, also on the daily. It just looks like a retest of this. So until we see like a lot, and I think this will be correlated to whatever NVIDIA does. So if NVIDIA ends up blowing out its earnings, it goes over, $1,000 or something crazy. Then we'll probably see DXY revert back to, probably make a move back towards the yearly open near 100. On the flip side of that, if NVIDIA misses, we'll probably see DXY run hot and just continue this uptrend that it's been on, and that would really be a risk-off signal if it continues higher. Right now, it's just kind of, it's had such a large move that's just digesting it, it looks like to me. I don't see anything here that shouts immediate risk-off or risk-on. It's just kind of keep it on your monitor, right? Because it is at extremely overheated levels. What's been offsetting this is these are great charts from Dharmafy on Twitter, Dharma Trade. You should follow him. Net liquidity levels are the highest they've been since April 2022. He tracks all these things and puts into nice, easy to follow formats. So even though DXY has been running strong, there's been liquidity coming in from other areas, which has been propping up risk across markets. So if that reverses at all, or if we see all of a sudden a risk-off shock through markets, if NVIDIA misses or any kind of these catalysts that could come up, we would see most likely DXY start to run extremely hot, and that could kind of create that liquidity Armageddon scenario we've been alluding to over the past few months. I think that's still a valid scenario and one you should be keeping on mind here until we see a firm reversal from DXY.
I want to continue on with that thought of that liquidity Armageddon that we've talked about. Ben, we've talked about the reverse repo going down substantially, maybe even going to zero, and creating a liquidity shock across markets as they're not really prepared for the central bank to really start adding that support. We did have a comment. I want to bring in some confluence here. Adam S. was asking about potential risk coming from other markets like Japan and the UK starting to look like they're trending into a recession. If you're taking all these factors, which I know is difficult, we're not going to be able to give a full lens or picture to the full macro environment. But how are you thinking about the potential for this liquidity shock as you start to see these factors as we move into March? As you were saying, like where the Dixie sits, knowing that the reverse repo is going to continue to be drained, knowing that there's some of these external factors, how likely is it in your mind that we see that liquidity shock that we've talked about, the liquidity Armageddon?
Ooh, that was a lot of things rolled up into one there, Marconi.
Well, if I'm going to ask questions, they got to be good, right?
They are good questions. That is for sure. And I would have to paint like a whole, master's level thesis here to explain my case in point here. But, on I guess 10,000 foot view here, there's some good news coming out of Japan. From what I was listening to end of last week, I think it was the chief economist out of Morgan Stanley was kind of discussing that. They just came back from overseas, saying that there were some good things. And he kind of gave out a nice little roadmap for what kind of their expectation is. And I kind of blended it with my own. I actually wrote it to the clients yesterday. And I'm going to pull it up right here so I can go ahead and reference some of it. Just what are we looking for down the road here for the next really remaining of Q1 and into Q2? I think we're going to at least have some discussions about the Fed kind of slowing down its process of QT. Well, it looks like that kind of is happening if JJ just was discussing that liquidity. So I went ahead and pulled up the balance sheet of the Fed, and it does have a little bit of slowing down for the past couple of weeks here. So that's contributing to kind of a net liquidity measure showing up on that Darmafy's chart. When the repo market gets drained, that's one of the biggest influences of that person's metric. Once that starts to go down to zero, that net liquidity measure is not going to be as valid anymore. And instead, we're going to have to watch treasury auctions to understand how much liquidity or excess liquidity there is in the market. And so the main stat we're going to have to be watching for is the cover to bid ratio. Right now, the auctions don't really look queued up to be anything in excess. So I don't see anything in the immediate horizon that's going to cause any of those concerns to flare up. I think the only, potential hiccup coming down is just the market. Is it expecting a cut in May or March? My base case right now is that we're not going to see a cut in March or May, but likely in June. Is that going to be a 25 or a 50 basis point cut? Based upon the Dixie this morning and the way that it's moving, it's either going to show us it's going to be a trend reversal, which wouldn't surprise me on how hot it was running for the last few weeks, or is this just going to be a kind of a one-day pullback and we're just going to kind of continue up? I think that's going to be a little bit of what we're watching for today. If we see NVIDIA, as JJ mentioned, and you see Dixie doing what it's doing, that's kind of troublesome to see those two moving together like that. So that'd be kind of a big red flag for me. But as far as that liquidity crash is concerned, there doesn't seem to be anything in the next couple weeks as far as on the horizon here. So,
well, we'll just have to continue to monitor that to see if that fat pitch comes down. As we talked about, it's a great trade. For those who are listening and wondering what that is, several episodes ago, we did talk about the liquidity Armageddon and ways in which people might play that from an options perspective. Definitely an early episode. So you can go check that out.
And just to add one more, sorry, Marconi, just to hop in here, but just one more point to watch. Like I said, we'll watch out for, but what to watch for, it's, the Fed has to discuss how it's going to slow down QT, and then it's going to have to address how it's going to handle the draining of this reverse repo market. Okay, right now it looks like they want to do that in May. I don't know if they have that much time on their hand. So is the market going to force their hand earlier than that? That I think is the case. So March, April, somewhere in there. So watch for that language to pop up.
All right, March or April gives us some indication. Well, with that gives us a good snapshot on where we are in the market. I think right now we continue to sit at some critical levels with Bitcoin sitting around 52K, Ethereum on the door at 3,000, maybe even crossed that this morning. Seems like we had some pullbacks. But I think from a risk perspective, Ben, you mentioned not necessarily a risk just time to be aping into some of those higher risk plays, even though they have gone very hot in the last couple of weeks. And obviously here the market is positioned with perps and with options to go either way. So just realize that the market is embedding in one direction or the other right now. It's prepared for higher volatility, and whichever way that goes, it's going to profit. So with that, let's talk a little bit about some positioning. I do want to cover the question that came in, two questions. One of them was around whether or not the Bitcoin miners are going to potentially have a pullback, or if they're going to continue to trade with Bitcoin, and what that may look like from a position or a play. And then there was another question that came in from Vinny. Vinny, good to see you here. Is hedging the perps better than buying puts? So we're gonna talk about all those. Before we do, if you're interested in options trading, I suggest you go check out CoinCall. CoinCall is a great place to be trading options, perps, and spot of your favorite crypto majors. It's got an elegant interface and, of course, competitive fees. We oftentimes highlight it on this show because it is so good. And there is a link in the description. Go check it out. Go start trading your options so you're ready for these big outside plays and so you can profit off them. And if you've got questions about how to do that, JJ has put together a series of videos, and he's adding to it as quickly as his fingers can allow him to do that, to write the script and do the video. But those videos are coming out. They can give you ideas for simplifying options so you really understand it from a trader's perspective, and most importantly, thinking about strategies that you can apply. So go check that out. And if you haven't already, hit the like and subscribe button. Love having you here. Want to get this out to as many people as possible, looking for a sophisticated trader's viewpoint. Right, JJ, let's come back to it. Let's talk a little bit about the CoinCall play that we've gone over a couple of times. It's looked like it's played out pretty well, and you've given us a couple of ways of looking at it, and maybe closing it out and opening up some other options. So what are you looking at now?
So what we discussed a few weeks ago when we were discussing kind of ETH and how underpriced it was at the time relative to the run-up it would experience. After the ETF, we said the December 2800 calls were a great position to take. And at that time, I was suggesting taking it unhedged. And I think this is the point in time where you would start to harvest that volatility. So if you're in that position, you have the 2800 call that's expiring in December. I think this is one of those points in time where you would look to start to harvest a little bit of volatility. So I think you could sell like these March 3200 calls. I think it's unlikely that we close the month of March above that level. So I think you could probably sell these against it. And obviously you're fully hedged. If price moves against it, you could sell, like if you have one ETH call, 2800, you could sell 0.1 here, 0.2. You don't have to sell necessarily the full position on a 1-for-1 ratio. And I think you could also look at some cheap puts. So if we're looking at the March expiry, you could get 2,700 puts here for $95, which is relatively cheap, especially if we experience any kind of liquidity crisis over the next month or so. It just gives you the peace of mind where you have that 2800 call that doesn't expire for another 8 to 9 months. And now you have some cheap protection here. So I think these are the kind of plays you want to be looking at throughout the course of the year, where you could basically sell some upside volatility and buy some downside volatility with that premium you collect on those positions.
It sounds just like what we were talking about earlier about not knowing which way the market's going to run. So being hedged either way.
Exactly. Nobody knows. So it's just about playing the probabilities, right? I think that this is a good way to look at it, is when insurance is this cheap, like this 2,700 call was last week, we were trading below 2,700. Now nobody wants to buy $2,700 protection on their ETH, and you could basically scoop that up for close to free here at these levels and hold it for the course of the next month without having to worry about a crash.
Okay. All right. For all those who are looking for some options plays, CoinCall is the place to do it. And each one of these videos, I would say over the last couple of weeks, twice a week, we've been going over your CoinCall and some of your other trades. So definitely, if you've got questions I'd say go check out those videos. Look at the timestamps. Go to the end of them. You can get a sense of how these trades have played out and what JJ's looking at. Okay, let's talk a little bit about beta plays for Bitcoin. So we had a question from Pancake Lord asking about the Bitcoin miners. We talked about them many times on the show as a beta play to Bitcoin. I'm looking at it now. It looks like we're seeing a little bit of a sell-off. We got Wolf down 14 cents. We've got a couple of the other ones, Riot and Mara, also looking like there's a bit of a pullback. What are you guys expecting here? Are you expecting them to trade at all differently? We've talked about on this show about how they're really going to move in lockstep but just be outsized, right? So if Bitcoin is starting to see a pullback, I would expect to see a pullback on those and just larger pullback. And of course, again, if it's moving higher, I'm expecting those to trade outsized. Has that changed at all for you guys?
No, I think it's the same. I think you missed this most recent move, so I don't think this is the time necessarily hop in. Like we look at Mara, just how quickly it went up and almost 2x'd in over the course of like a week, right? So you look at February 8th, it was trading around 16, and then next thing you know, it's at 30 last week. So it needs time to digest this move. I don't think now's the right time to hop in unless you expect Bitcoin to be trading at, say, over 55,000 by the end of this week. Then you could see this move up above 30, possibly even size like 35 to 40. But your risk reward here, like if Bitcoin goes below 48,000, this is probably going back down below 20. So you really like these moves, you want to catch them at the lows, ride them up and get out as soon as possible because they move so quickly that if you try to catch the dip too early, you're going to get burned. And if you short them at the wrong time, you're also going to get burned. It's a fast moving vehicle. It's like alts, essentially.
So you're expecting some kind of pullback based on the fact that this has just gone so hot so fast.
It's just dependent on Bitcoin. So if Bitcoin makes a move up above 53,000 to 55,000, then you're going to see these accelerate again. But your risk reward here, right? Like if Bitcoin goes below 48,000, you have all of this downside that's going to follow with it. Like there's no scenario in which Bitcoin falls below 50,000 and these go to above 30, like Mara, for existence. This isn't going to go above 30 if Bitcoin pulls back below 50. You're just betting on higher prices with Bitcoin, and it's like using leverage without having leverage, essentially.
Without having leverage.
Same thing with all these stocks. So it's just, you have to be extremely quick with these. You have to be in and out with your positioning.
I'd be curious what the implied volatility is on some of these puts, because based upon this, what is likely to be negative beta on Bitcoin, it could provide a nice hedge.
Mm-hmm.
I mean, pull them
up.
Massive
yeah,
gaps.
Why are you doing that?
Coin.
I do want to ask the question and get to it from Vinny, which is hedging with perps better than buying puts? And so as you're pulling this up, let's kind of discuss that. I want to get your perspectives there.
I like puts personally, but it's all about how comfortable you feel managing trades and whatnot, and understanding how the put premiums move. Like perps, it's kind of easy. It's just a 1-for-1 tracking of the underlying. With puts, there's a little bit more of a larger equation to figure out there, but it's all personal preference. Like the good thing about perps is put options is you can't get liquidated. So if I buy a 50,000 put that expires in March, it expires worthless. I don't get liquidated on my position. If I short perps at 52,000, price goes up to 56,000, I use high enough leverage, I lose all of my position there. So you can kind of cap your downside and figure it out how much you're actually risking in a way that's a bit more easier than perps. But
yeah, if I was more of an active trader, less of a researcher, I probably would prefer perps. But for some of the reasons JJ mentioned, like the environment changes pretty quickly, especially with funding rates and your margin when it comes to that it's not like, for me, that's not my preferred vehicle. Puts offers me kind of a little bit of a lower time frame movement. I don't have to pay as close attention hour to hour as you would with trying to hedge your portfolio with a perp.
Okay, Vinny, I hope that gives you some perspective. You can think about whether or not you want to be using perps or using puts. Obviously, some benefits and some challenges with each one. But as JJ mentioned, it could be a personal preference. Also, level of sophistication. I think there is a little bit of a learning curve with options, which is one of the issues that JJ you're trying to really dispel. Is take those complex concepts, break them down to something digestible that the everyday trader can use to make sophisticated trades.
Yep.
Okay, so JJ, were you in the middle of pulling up the implied volatility on those?
I'm not looking at the implied volatility. I'm just looking at different strikes here on Mara to see what looks attractive, possibly. So if you look at March 8th, 20 puts on Mara. So
Hey, we're currently looking at the price chart. Were you pulling up something else?
Oh, see if I can get in there. I have it on dual screens.
Okay.
But I mean, either way, you're paying a lot for these because the price moves so quickly. So implied volatility is high. So you have to think of like the likelihood of these things happening. It's just kind of an extreme beta. Nothing that's really jumping out is like, oh, this is an easy trade. So I don't even think we have to cover.
So you're saying buying options on these miners right now. You already talked about expecting some kind of pullback unless Bitcoin's able to rocket higher. But expressing that trade in options on those looks even riskier.
Yeah, it's much higher risk than Bitcoin because it's ultra levered, essentially, right?
Yeah.
So you look at these things and the way they trade, it's just difficult to find a meaningful opportunity there. I think if you looked at those puts expiring in 2 weeks at 20, they're trading for below $1 each. I don't think that's a bad play because obviously if the downside comes, it's going to come quickly, but it's already trading down 5%. So you're buying a lot of downside premium already. They've already jumped. It's not a great trade, I don't think.
Okay. You don't want to get your fingers burned at this point. There's going to be plenty of opportunities in the future. So stay sharp, stay prepared, and look to time your entries. And with that, I think we are going to wrap up today's show. Looking at the markets, Bitcoin sitting about 52,000, Ethereum just under that 2,936. So we're continuing to see some momentum. We're going to continue to look at those ETF flows to give us some kind of indication of where the market is headed. But for now, it looks like it continues to be consolidation. JJ, Ben Lilly, thanks for joining me today. This is Marconi White. And as always, I will leave you with the PSA. Thanks for joining us. We're here every Tuesday and Thursday. And have some dry powder. Those opportunities will happen. You best be prepared. Till next time.